All the content on this channel is for education or entertainment purposes only. It does not constitute financial advice. Always remember to conduct your own research. So in today's video, we're going to be running through the truth about high yield ETFs. And now I have got close to 18 months worth of data and real life testing. So let's jump into what I have learned in the last 18 months. So this is the truth about high yield ETFs. What 18 months of real testing has taught me in this time, the hype versus reality. And I think in this last 18 months, I have actually learned a lot. And the reason why is before income shares came about, we could just really watch what YieldMax was doing. And other ETF providers, we didn't really experience them for what they really are. So this is really why I wanted to try high yield ETFs and see how we can use them in a real life scenario. It was June 2024 when they first came out, so we're not far off 18 months worth of data now. And I've tried everything. I've tried the UK versions, I've tried the US versions for the last 3 months. And I'm going to give you my honest opinion on how I think these ETFs should be used in real life scenarios. So this is my honest experience. And I've been testing these out for the last 18 months. So far, I've used covered calls, I've used put strategies, I've used leverage products such as the Roundhills, and there's been times where I've even written my own options. And my biggest takeaway from all this is yield does not equal return. And that is the biggest thing I see investors struggling with, and also myself, I've struggled with, is FOMO. Is when these things are going well, you want to put more money into them. And then you end up with a lot of money in, let's say, a fund. And then we get a couple bad days of the stock market and all your gains are wiped out, what you've earned for the last 3 months. And that is a major problem with high yield funds. So yield does not mean return. If the NAV is eroding over time, that income you're taking is just your own money being returned to you. And that is the honest truth. Because there's been times where I've had a fund up 20, 30%, let's say 20%, and then we have a bad week in the stock market, we have something like tariffs come, something like April happened, and all your gains are wiped. These funds work great in a bullish environment, but as soon as you have a bit of turbulence, it wipes all your gains away. And that is the major problem with high yield funds. Total return matters a lot more than the headline yield. And I do want to touch more on that scenario because I do think high yield ETFs can be used inside my portfolio and inside your portfolio. But I think they've just got to be used in a certain way. And I've tested a lot of different strategies over the last 18 months, and I've done it on purpose as well. Because when I first started, I had a 10% yielding portfolio, and it had dividend growth in there. It had income in there as well. So it was all going great. I was up about 10%. Portfolio was around 30k in value. Everything was gravy. And then these high yield funds came around. If I'm being totally honest, I think my old portfolio, I would have been better owning my old portfolio than switching to any of these high yield ETFs. And that is the honest truth. So this is how I see high yield funds working for you and for me. Always pick the right underlyings. What I mean by right underlyings is the highly volatile names can look great when you're looking at the yield. So we're talking 80, 90, 100% yields. But these are the kind of high yield funds that you need to stay away from because they're great while they're in the bull market. But as soon as you get some volatility within the markets, that all your gains just disappear. I've been the first witness of this. Income shares were great when they first came around. Even with the cap strategy, we had funds that were up 30, 40, 50% on total return. And then April happened. The portfolio was just red, a sea of red for the next 6 months. I'm still struggling with some of the funds that I've still got from it. So always pick the right underlyings. And that is going to be different for everyone. For me, it's AI related things, semiconductors, growth assets. that I believe in long-term, like Broadcom, Google, these kind of things, not the highly volatile ones. I think that's a problem. And you can see it in the assets under management as well when you look at the fund. For example, if you look at Ulti's been doing shocking this last couple of months, and it's got one of the highest assets under management of a high yield fund that there is out there. That just goes to show that investors really do follow yields, not total return, and that is the biggest issue. And I have been a component of this as well. I have FOMO mode. It's human nature to do, but I think you need to stick to a structure, and you need to make sure you don't cross that line. When you've got your goals and your plan in place, stick to it and don't let FOMO take over. And investing is all just a big learning curve, and I think I'm so glad that I have tried these out and I've done what I needed to do, and I've done 18 months of testing, because the way I work, the way I like to learn is I like to jump in and I like to do things, and I've always been that way. And to educate myself, this is why I want to jump in and try high yield funds. But without testing it out, I wouldn't now know how I could use this in my own portfolio. But now I know how to play it, and I do want to talk a little bit more about that. So what I think really works long term, and what the best funds are funds with a stable NAV and market-like returns. So when I say market-like returns, what I mean is the S&P, the NASDAQ. So we're talking 10 to 20% returns. When the yields are going to be under 30, 40%, that really seems to be the sweet spot. Like when you see we've got funds like YMAP and FEPI where they're around 25%-ish to 30% yields. For me, I think these are going to be the best funds out there. I think anything with a eroding NAV, and what I mean by NAV erosion, I don't just mean where the fund is going down because the underlying's gone down. Like where, for example, when we had Coinbase ETP and it was a cover call strategy, when we were literally losing shares every week because we were getting called away, that is NAV erosion. That is real NAV erosion. Not just the fund going down because the underline's going down, like we see with MicroStrategy and MSTY or MSTI, for example. That's not real NAV erosion. But when we're getting called away because the strategy's not working, like we see with Coinbase ETP, that is real NAV erosion. I've made a little example here just to show you. 18 months of testing, when we're talking yield versus total return, you've got TSYY, for example, which is Tesla ETF. And then we've got TSLD, which is income shares Tesla. These are the same lines, but a totally different strategy. One's using leverage and puts, and another is just using puts and holding the stock as well, 25% stock. Same underlying, two different strategies, but totally different scenarios. So TSYY, we have 140% yield, and I think that's on the low end. I've seen these funds go over 200% yield, and it's up 11% in 3 months, but the NAV is down huge. And if this NAV wasn't down half as much as what it is, then the total returns will be pretty well. And the payments are just going to keep going down as well when the NAV goes down. As for example, if Tesla goes down, you get paid less. If the fund goes down, you get paid less, etc. But at the same time frame, we've got a moderate yields by income shares, where it's like 40, 50%-ish. I haven't checked exactly what it is, but they aren't paying half as much out as they did on the old strategy. And this has had 41% total return in 3 months. It's now got a stable NAV. If we look back over since the strategy change, the NAV is stable. It does fluctuate with the underlying, but apart from that, it's not eroding like it used to. And it just goes to show, total return, having a stable NAV and a decent yield is a higher total return than having a higher payout and a eroding NAV. And I've got quite a lot of data on this. This is just one example. And I've been back testing as well, some numbers, which I'm going to share with you. And it's rather interesting. So high yield, 60 to 80%, they're great in bull markets, but as soon as you get a correction, wipes all your gains out. And I've been a witness of this where my portfolio has gone up 10%. As soon as you get a couple of days where the market corrects, I'm back to square one, exactly where you started. And when this happens, you really can't be drawing income out of your portfolio. So in my eyes, I don't think having a 100% covered call portfolio is ever going to work. and I've been testing things around it, especially the US portfolio, using some hedges, etc. But I just don't think a 100% cover call ETF portfolio is ever going to work. So why most investors fail with high yields? So they chase yield instead of total return. And this is what we just spoke about. This equals the NAV falling way too much. Most people jump in their high yields without understanding that every percentage, usually over 40% or maybe even less at 30. The reason I put 40 is because we're now seeing some stable NAVs coming through by income shares, but without those income shares products, I would even move this number down to 20, 25%. So that number at 40 may even go down to 25%. Yeah, we'll have to see how income shares products do in a bear market. But one thing I do want to mention is that I have now done the UK and the US. And the outcome is still the same. When you go to a certain yield, you just get an eroding NAV. It's simple maths. If you go so high with the yields, what happens is they are paying out too much of the NAV, so your NAV will go down over time. We have seen some higher yields with a stable NAV in America. For example, you've got CHPY, GPTY. These are doing great. They go up on a capital gains basis and they pay a decent yield. I think it's around 40, 50%-ish, depending on the volatility of the market. It could be even lower if there's low vol. But once you start going over them kind of numbers, and we're talking 60, 70, 80%, we are seeing some NAV decline, let's say. So people want the income now, but forget longevity. And that is the main issue. So when these corrections come, or we see a continuous bear market, like a really long bear market, then you're going to get hit really bad. Chasing yield over total return is probably the worst thing that anyone can do in the portfolio. And it's FOMO. I've been a component of this myself. We've seen people in the community do it. For example, just going full Coinbase, 100% Coinbase, for example. They're not doing it because they like Coinbase that much. It's just because they were chasing yield. And you've just got to be able to control it when you're investing in high yield funds. So this is my recollection of when high yield backfires. In the bull markets, these look amazing because you've got the underlying going up and you're getting paid a 60, 80% yield. You're really putting some more money into it because you think it's doing really good. But the problem is, as soon as you get a market drop, your total return gets wiped within days. We've seen this happen when the market's dropped 20%, the underlying drops 20%, and that comes off your total return. And it's hard to get back to where it is. These high yield funds, they really struggle to get back to where they are. And that's a major problem. These are the products I think are going to work best in people's portfolios, and including mine. And you'll start seeing changes in my portfolio moving forward to these more type of products than the higher yielding ones. So we've got funds like YMAG, we've got FEPI, SEGI. They have balanced structures, so baskets of stocks rather than single stocks. Don't get me wrong, single stocks are fine, but I think when we're talking single stocks, we're talking the lower volatility stocks. So we're talking Amazon, Google, probably Broadcom's like a medium vol stock. But I think these are the products that are going to do best. Lower yielding income shares, gold ETP, silver ETP. And then we've got like the JP Morgan type products. And what I mean by that is not just JP Morgan, I mean like the 10% yielding products. So you've got your Goldman Sachs's, GPIX, you've got NEO's products. I think these are the products that are going to have a stable NAV over time, but you're still getting paid. And that is really how you get this good total return. And we've seen it where, for example, you got FEPI, you got YMAP. These share prices, even at 25, 30%ers, the share price is going up while you're still getting paid this yield. So yeah, really, I think these are the products that are going to work best inside a covered call portfolio. And this is the power of compounding. This is an example of £1,000 a month invested over 5 years and invested into 2 different funds. So on the left, we've got a 60% yielding high yield fund where the NAV drops by 15% per year. And then on the right, we've got a stable fund, which is 25%, but it has 0% NAV change. And we have two different end prices. The high yield fund is 52k and the stable fund is nearly double at 89k. So this just goes to show the difference in the value of your assets after 5 years. And even though it's only 15% NAV decline per year and you're getting paid 60%, you're still worse off than investing in a stable fund that pays nearly 3 times less. Stable compounding beats high yield every time. Consistency wins over flashy returns. And that's the problem. We're seeing it with income shares to start with. When they were just pumping the yields up, we're talking 100% Coinbase, 150. We've seen it all over 200% at one point. And I think these fund managers pump the yields up because that's what brings the assets under management in. And you can just look at MSTY when it comes to Europe. I think the number's on 25 million, but the fund that's actually done the best, what Han ETF have brought over, has got the worst assets under management, but it's got the best total return. So yeah, that's really something to think about, and it's something I've really been compiling a lot of data on lately and back testing. And every time it comes back to this, the stable fund always wins. So this is my 25 to 75 rule. And I've been doing a lot of back testing. It's been nearly 2 years now. Now, I'm back testing before these come out for Max products. I've been back testing all the way through. And people in the community have also been doing it. Every time I've done a back test, it showed that around 25 to 30% exposure to income is the perfect mix. And I've been trying to push that more and more, doing 100% portfolio, seeing what actually happens. And the real life testing confirms it. And I've back tested and back tested. And this is basically the mix that you can have. There's 25% high yield ETFs and 75 growth assets. Now, this may not be for everyone, but when I'm talking about this rule, this is for people who want to grow the wealth at the same time as be financially free. So if you want to be financially free by living off your portfolio, but also you want to grow your wealth at the same time, so your assets are going up while you're still getting paid, this is the ideal mix. 25% income ETFs and 75% growth assets. I've really been testing a lot for the last 18 months and there's just no way around it. As soon as you start pushing the numbers above that 50, 60, 70% income, your capital gains go down, unfortunately. But please remember, every investor is different. So someone who's closer to retirement will probably have a different mix to this. This is mostly set for myself at the position I'm in. I'm 31 years old, so I want to grow my wealth at the same time as have assets that pay me and eventually be financially free off the assets while I've still got all my growth assets in my portfolio going up in value. So final thoughts from here is don't chase the biggest yield, focus on total return, stable NAV and assets you truly believe in. That's how you're going to build cash flow and grow long-term wealth. Though your goals may be different, if you don't want to build your wealth long-term, you can put more risk on the portfolio by having a bigger percentage in cover call ETFs. Or if you don't want that much income at all, you can also have more growth in your portfolio. It all depends on how your goals align. But for the average investor who wants to be financially free off the portfolio and also grow the wealth at the same time, I think the 25 to 75 rule is going to be the main key. So this is my high yield investing framework, and these are what I'm going to be sticking to moving forward. You will see my portfolios changing. Focus on 40% yield or less. Prioritize total return over headline yield. Choose underlyings you believe in only. Keep high yield to 25% max of the portfolio. Reinvest income for compounding. Income plus growth equals freedom. If you're not subscribed, guys, please subscribe if it's your first time here. And if you found this video did help you, drop me a like below. And also let me know in the comments, what is your ideal mix? Is it 25-75, or is it 75 income, 25 growth? I'd love to know everyone else's mix. So thank you so much, guys, for watching. And in case you missed, in front of you right now is Han ETFs distribution announcement for the month of October. Thank you, guys. See you in the next one.